SMF, MMTs, and everyone that we know around the world is that, once again, we always try to tell people that this bull rally reversal, a lot of people get into trouble. They just don't listen to the tape. And the thing of it is, when we were up here at overbought levels, we were 87% on a weekly. Now we're down here on the weekly at 50% throughout the reversal. The bear factor is that the last bottom is right here from our last correction at 1251, and we put in that blow off top, and that went into the middle of the year, and it's going to give it all back up. And the thing about it is, if the blue line crosses over the red line, that's called a 10-week moving average, it crosses over. And if you close below the S&P, it has to be 4 weeks. So here's 1 week below it. That's the close below it. Here's the second week. You have to have 4 consecutive weeks, and that blue line, the 10-week, has to go down, descend. It has to roll over. That would validate that it's a bear cycle, no longer a bull cycle reversal, my friends. Now, my friends, here is a daily chart of the S&P 500, okay? And I'm going to clear these trend lines here. And this is the top of the daily reversal. These were your counter trends, and you made lower lows all the way down. Here you are. Now, the green line just so happens to be where the last lows were. That's a 200-day simple moving average. Now, outside of that weekly, short-term volatility needs to be addressed when there's short-term. We're in an oversold condition now on a daily, using a daily oversold. That means that the market is set and right for a short cover rally bounce from the original reversals from May to current. And as the sellers get cleared out, that 200-day moving average is right there at 250 now. And basically, we're pricing in a huge bounce off of that 200-day moving average based on the short-term oversold. And that's where you want to get ready to get long the names off of the bottom when that happens. And this will happen on the S&P. And it's something that all of you are going to learn, is that we are breaking down here on the weekly, and we're still at a level where we're not overbought like we were. And we were, it's all on stockmarketfunding.com. This whole reversal, people had a chance to get out. Would they listen? No. Bulls never listen. Bears never listen. And the thing about it is, you got to listen to where the buyers and the sellers, and where that overall sentiment changes mentally with people. The bear and the bull count. And all the bulls were in. And the bulls now are having a different view. Maybe that's contributed to Bernake and a few other things that have been going on in the last few days. Not to mention all the ugly economic indicators are going down. So, short term, this is a MACD bar, my MMTs. We're going to hit a bottom here, and we're going to bounce like a rocket. Because short-term oversold have bounces within trend reversals. You don't just keep going straight down forever, just like you couldn't go higher over here when we called the top, and every counter rally that we talked about failed, and we made lower lows. And stockmarketfunding.com for its MMTs have all of those index analysis done on the monthly and the weekly. And we did them going back at the end of April through May, and before May started. And we're in the first good week of June trading. And the first week was a continuation sell week. And basically people are locking in profits from the longer term bull rally. Now, people are changing their decision processes. I don't care about all that. What I care about with my MMTs is where I'm going to get that short cover bounce and picking the leadership like Goldman that's oversold, and stocks that are in that S&P that we will pick out. Let's say we'll pick out 3 or 4 of the leaders that are the most deep oversold area on weekly charts. Now, Goldman Sachs does have a little bit of an overhang with regulatory financial, but it still will bounce off the bottoms. There are other good ones that don't have that regulatory overhang hangover, that will bounce that are oversold. So when we bounce from the S&P, we get a list of stocks that bounce with it. And then we go to work and we start making markets there, my MMTs. Short-term oversold S&P on a daily. Longer-term reversal remains. We have not closed below these key weekly moving averages, my friends, for a long, long time. You got to go back over here. Let's go to 2010 on the weekly. When that blue line and the red line and all of these things were rising, that's part of a bull trend. But now we're getting the evidence from the top here that this thing is starting to change directions. Once it does change directions, just like when you're below the moving averages and you close 4 weeks above these lines, that's a new bull trend. But it has to be 4 consecutive positive closes in a row. It can't be 3 or 2.5 weeks. No. And same thing over here. MMTs, it's same thing. Now, standard, all of this is standard technical analysis that big money decision makers use. That crosses over. We're going to come down. This is going to be a key moving average. This pink line is a 50-week moving average. That's at 1233.37. One of the things that you're going to be learning that when we do put that bottom in is what are the patterns that go with bottom reversals versus top reversals. So for the new people in the school, you're going to start learning that phase of it until we get to the next overbought phase, and then you'll learn the back end of it when it comes then. Now, some of the enrollees that are here with us today have already gone through this one right here that we called at the top, and now they got to go through a double. So, but they also had a chance to know how the bottoms, and one thing about bear and bull rallies is just like anything else, the bull gets exuberant at the top, doesn't come out. Bears at the bottom don't come out of the shorts, and they get a lot of pain coming if they don't know what they're doing. That is the update on the S&P 500, and that is the oversold condition from the original reversal and the time and length of that reversal, my MMTs. And once again, I'm going to take a diagonal trend line right here. And I'm going to take these lows right there at these lows. And all these dots match perfectly. Okay? And this is where we're at a crucial level that a break below here. Short-term bounces, short-term MACD oversold. 200-day moving average will come into play, and it's healthy for us to come down here like this. But the bull crowd is changing a little bit. But let's see if they change. If we were to gap below that thing, or we come down and sell through that weekly or daily 200-day moving average, well, you'll see a lot of selling, and all bets are off in that case. It won't bounce. And sometimes they have to go below that, but not a lot, just a little bit, and then a big reversal comes in. So we've got a good key factor and good key analysis as to what the index of the S&P 500 will do. And not only that, my MMTs, we'll come over here at all 500 MMT S&P stocks, is that we will pick out the leaders of the S&P 500. Ones that got good dividend yields, one that has good business models, ones that are still kicking, even though that the economic environment, GDP is lower, but there are good names in here that institutions are going to want to own. And it's all about identifying those so that when you have your 4 or 5 stocks out of here of the S&P that will go with that reversal where it will bounce, that 50-week moving average is where that we took out a double weekly top and made the all-time highs, burning off that 2010 to that 2011 top. And that is ultimately going to be that support right there at that pink line, which is a 50-week moving average. And a quick move down intraday and a bounce off that 200 was short-term oversold on the S&P 500. How to trade the S&P 500 and why the bears could do the same things when the bulls aren't getting out up here at the high overbought. Well, when we get oversold, the bears have a tendency to stick around too long. And, you know, it's all about bear and bull price action volatility.